Yeah, in this video, we are going to see what are the steps that are to be followed while solving the sums on income from capital gains. There are three steps the student should understand. Step number one, holding period. Just find out the holding period. Holding period is a period between the purchase date and selling date, and how many months or how many years that the particular capital assets are held by the assessee. So here we have a list of assets, and here we have the provisions to call them as short-term capital assets and long-term capital assets. Let us take one by one. For listed shares, if the shares are held by an assessee for less than 1 year, that is 12 months, those can be short-term capital asset, and if it is more than 1 year, it is a long-term capital asset. And I'll tell you the let me simplify. If if I sell the shares within 1 year, it's a short-term capital asset. The gain is a long short-term capital gain. And if I sell the shares of any company, listed shares after 1 year, then it is a long-term capital asset. The gain arising out of such a transfer will result in long-term capital gain. So for unlisted shares, it is less than 12 months short-term capital assets. If it is kept for more than 24 months, it is long-term. For land and building, I am telling this too because we have the different option to be exercised by an assessee for land and building. The land and buildings are kept for less than 24 months. It is a long short-term capital asset, and if it is kept for more than 24 months, and it's a long term. For assets like jewelry, gold, silver, any other assets for that matter, again 24 months and more than 24 months. Now we'll understand common idea or common understanding is that if any asset is held for more than 24 months, it is very obvious that these assets are long-term capital assets. And for short-term capital, for short-term capital assets, we have a different formula. And for long-term capital assets, we have different format for calculating the income from capital gain. And once this step is done with, then we will have to go to step number two. Step number two, if it is a long term, for example, if it is a long term, then we have to see when was the asset sold. If the assets were sold before 23 July 2024, then there are certain provisions. And if the assets are sold after 23 July 2024, we have different tax treatment. Now let us see the first one. If the assets were sold before 23, or any assets, invariably all the assets should be indexed. See, listed shares we have, it should be indexed. Whether it is unlisted shares, again it should be indexed. For land and building, any other assets. Also, before 23, if the sales were made, everybody should, I mean, all the assets should be indexed. And now, what happens if the assets were sold after 23 July 2024? Only, just look at this. Only for land and building, we have options. No, for listed shares sold after, no indexing. For unlisted shares sold after, no indexing. And for any other assets which are sold after 23/7/2024, no indexing. And if the land and buildings were sold after 23/7/2024, we have to show both options. For example, index with 20% tax rate, and no indexing with the. So here total idea is that if the assets were sold after, only land and building can be indexed, other need not be indexed. So this one, if you keep this one in mind, then automatically we will solve the sum. This is a format of short-term capital gain, sale consideration, nothing but sales value, how much the assets were sold, right? And expenses on sale, it can be stamp fees. Any expenses which are related to sales can be deducted from the selling amount, and that will result in net sale consideration. And from that, cost of acquisition. Cost of acquisition is nothing but cost of purchase, how much incurred to purchase the amount. Then cost of improvement. It can be, supposing you are purchasing ground floor, and after 2 years you build a second, you construct a second floor, that is improvement. Or any additional work, any additional expenditure you have done for the existing asset, it can be in cost of improvement. Okay, therefore without indexing, actual cost, actually this is actuals we have to take, actuals. Here also, what, how much has been spent, actuals we have to. So I am telling you actual because you will understand when we go to long-term capital and exemption under section 54 and exemption under section 54D. When you deduct all this, you can claim your exemption, and the final result will be taxable short-term capital gain. And this is a format of long-term capital gain, except the difference is index. So in the, we need not, we will not show the actual cost because the gain will be very huge. For instance, if the assets were purchased before 2001 or even in the year 1960 for 50,000, it is irrational to deduct only 50,000. We have to see what is the cost now. So that is a fair rental value. What is the cost for the current previous year based on the cost inflation index? So that is what we call it as indexing. Okay, indexing, we take cost inflation index is taken into account, cost inflation index. So using this, we will find out the cost for the previous year. And the exemptions we will deal in the next lesson, next video. All these can be claimed by an assessee, and final result is long-term, is taxable long-term capital gain. I am telling you taxable because this is the value where we can calculate directly the tax on capital gain. So thank you.